In a world where cars are evolving rapidly, it seems like every vehicle on the road is now sleek and quiet. With the current state of the economy, many wonder how they can keep up with the times. It's easy to feel like everyone else has cracked the code to effortlessly afford these modern rides. But what if I told you that getting your hands on a new car while also financing it is simpler than you might think? Right now, countless individuals are financing their cars and paying for them by driving with Uber in North America. Uber isn't just a ride-hailing app, it's a pathway to financial independence, whether as a primary income source or a side hustle. Ride-sharing and food delivery have emerged as viable options for many seeking financial freedom. In the first part, we explored leasing a car for Uber. Today, in the second part of our Did You Know series, episode 3, we focus on financing. Join us as we walk you through a straightforward plan to kickstart your Uber business, even if you've recently immigrated to Canada. We'll discuss the advantages and drawbacks of financing along the way, shedding light on some essential terms you should be familiar with in the financing world. And that's not all. Have you ever wondered how to write off your car as a business expense in Canada? Stick around because we'll cover all that and more in this video. Let's start by understanding what financing means. Simply put, it's like taking out a car loan that you gradually pay back over time. So now, let's check out the main pros and cons of financing. Pros of financing a car. Ownership. When you finance a car, you eventually own it outright after completing the loan payments. This means you can keep the vehicle as long as you want and build equity in it over time. Unlimited mileage. Financing typically doesn't come with mileage restrictions, so you're free to drive as much as you'd like without worrying about penalties. Customization. You have the freedom to modify or personalize the car to your liking. Whether it's adding accessories or upgrading features, you can make the car truly your own. Also, you have the flexibility to choose between new and used cars. Long-term savings. Over time, financing may be more cost-effective than leasing, especially if you plan to keep the car beyond the loan term. This can lead to long-term savings compared to leasing. No wear and tear charges. Unlike leasing, you won't face additional charges for excess wear and tear when you return the vehicle. This gives you peace of mind knowing you won't be hit with surprise fees. Now, the cons of financing a car. Higher monthly payments. Loan payments are typically higher than lease payments, which can strain your monthly budget and require careful financial planning. Depreciation. As the car ages, its value decreases, affecting your equity in the vehicle. This means you may owe more than the car is worth if you decide to sell or trade it in the future. Maintenance costs. You're responsible for repairs and maintenance costs beyond the manufacturer's warranty, which can add up over time. It's important to budget for these additional costs when financing a car. Long-term commitment. Financing ties you to the car until the loan is paid off, limiting flexibility if your circumstances change or if you want to switch to a different vehicle. Interest costs. Interest accrues over the loan term, increasing the overall cost of the car. This means you'll end up paying more for the car in the long run due to interest charges. With that in mind, let's compare financing to leasing. Leasing is similar to renting an apartment. You don't technically own the car. At the end of the lease term, usually around 3 years, you return the car to the dealership. Unlike financing, you don't build equity in the car during the lease. However, you get to enjoy lower monthly payments compared to financing, and you get to drive a brand new car with the latest features. But remember, leased vehicles often come with mileage restrictions, and going over this limit can lead to extra charges. Also, when you lease a car, it's usually brand new, so you get to experience that awesome new car smell. Which option is better? Well, it depends on your preferences and lifestyle. Financing may be the right choice for you if you want full ownership, don't mind higher payments, and plan to keep the car long term. It's like steadily building your financial strength, one payment at a time. Leasing might suit you better if you love driving the latest models, want lower payments, and enjoy switching cars every few years. It's like test driving with a new car always available. Ultimately, both financing and leasing have their perks, so it's essential to weigh your options carefully and choose the one that best aligns with your needs and preferences. Now, let's turn our attention to 12 terms you should be familiar with on your road to ownership. You've likely encountered these terms before, but what do they really mean when it comes to getting a car loan? Let's find out. To begin, first, second, and third chance credit. These terms are all about your credit score and how likely you are to get approved for a loan. In other words, they tell you how risky you are as a borrower when you want to buy a car. First chance credit. This is for people with really good credit scores, usually above 650. They have an easier time getting loans with good interest rates. Second chance credit. If your credit score is okay or a bit dinged up, usually between 550 and 650, you might fall into this group. You can still get a loan, but you'll likely pay higher interest rates. Third chance credit, also known as in-house financing, is for folks with poor credit scores, typically below 550. It's harder to get approved, and if you do, you'll probably pay even higher interest rates. So how do they affect getting a car loan, and who gives them out? That leads us to our next term, providers. The providers are different lenders, including banks, credit unions, and specialized auto financing firms, extending loans across these credit tiers. They can also be dealerships themselves that provide in-house financing, directly offering loans to customers with less than perfect credit, as interest rates may be higher and the repayment terms may differ from traditional loans. Now, what's an interest rate? It's the cost of borrowing money influenced by your credit score. The principal, it's the amount you borrow for the car loan. Monthly payments. These are the regular installments you make to pay off your loan. Some lenders also provide weekly and bi-weekly payment options. Loan term length. It's how long you have to repay the loan, affecting your monthly payments and interest rates. Down payment. This is an initial payment you make up front to reduce the loan amount. APR or annual percentage rate. It's simply the total cost of borrowing, including interest and fees. Loan to value ratio, or LTV for short. It's a comparison between how much money you borrow for a car and how much the car is actually worth. Imagine that you want to buy a car that costs $10,000 and you borrow $8,000 from the bank to pay for it. In this example, your loan to value ratio would be 80% because you borrowed 80% of the car's value. It helps lenders understand the risk of lending you money compared to the value of what you're buying. Credit score. It's a number that shows how trustworthy you are with borrowing money. Pre-approval. That's when a bank or lender checks your financial background and gives you the thumbs up to borrow money before you start looking for a car. It's kind of like when a bank offers you a credit card, even though you didn't apply for one, because they see you're responsible with your money. Collateral. Your car itself acts as collateral, securing the loan. Just like a promise to the lender, if you can't pay back the loan, they can take your car to cover the money you owe. Understanding these terms will help you navigate the car financing process and make the best decisions about your loan options. If you've been finding this info helpful, hit the like button. It'll help spread the word to others like you who are thinking about driving with Uber. Now on to the next topic. So without further ado, it's time to grab your pen and paper and let's dive into the step-by-step process of financing your car for Uber. Step 1. Set a budget. First things first, let's figure out how much you're comfortable spending on your car each month. Take a good look at your income, monthly expenses, and any savings goals you might have. Step 2. Check your credit score. It's like the backbone of your loan application. Having a good credit score can really open up some doors for you, so let's aim for that. Step 3. Research loan options. You can check out what banks, credit unions, or even online lenders have to offer. Take your time to compare their rates and terms to find the best fit for you. Step 4. Choose a car. Alright, time to get to the fun part, choosing your dream car. Find a vehicle that not only meets your needs but also fits nicely into your budget. Step 5. Get pre-approved. To get pre-approved, you typically need to submit some basic financial information to a lender, like your income, expenses, and credit history. They'll review your information and let you know how much they're willing to lend you. This gives you more negotiating power when you're ready to make a purchase. Step 6. Compare interest rates. Shop around for the best interest rates from different lenders. Step 7. Negotiate the purchase price. Don't hesitate to negotiate with the dealer for a fair price. Step 8. Review loan terms. This is very important. Before we seal the deal, let's take a careful look at all the loan terms. I can't stress this part enough. Pay close attention to both the interest rate and how long you'll be making payments. If you're not familiar with interest rates, YouTube offers lots of helpful content about this. You can also ask an accountant or someone you trust, like a friend or family member, who knows about this. Understanding these 2 points is really important for making informed decisions. We want to make sure everything's crystal clear before moving forward. After all, you might not want to be driving for Uber for the next 50 years. By then, that car won't be so new anymore. Step 9. Sign the loan agreement. Once everything checks out and you're happy with the terms, it's time to put pen to paper and make it official. And step 10. Drive off with your car. And there you have it. You're officially the proud owner of a new car. Congratulations, it's time to hit the road and enjoy the ride. But wait, here are 4 important points to consider when financing a car for Uber. 1. Fuel efficiency. Picking a fuel-efficient ride can help keep your operating costs down, leaving more money in your pocket. 2. Insurance. Make sure you have the right insurance for rideshare driving. Regular personal auto insurance might not cover it. 3. Depreciation. Cars lose value over time. Keep that in mind when budgeting for your loan and overall costs. 4. Maintenance costs. Don't forget about regular maintenance like oil changes and tire rotations. It's all part of the gig. With these points in mind, you'll be cruising towards success in no time. Now, what to do if you are a fresh new face in the country? Don't worry, the next steps are exclusively for the newly arrived immigrants. Step 1. Open a Canadian bank account. Establish a local banking relationship for smoother transactions. Most immigrants can easily find banks or credit unions from their respective communities in virtually all Canadian provinces, facilitating communication and access to financial services. Step 2. Build credit. Start by applying for a secured credit card to build your credit history. Step 3. Learn Canadian driving requirements. Obtain a valid driver's license that meets Canadian standards. Step 4. Purchase car insurance. Get the necessary insurance coverage before driving your new car. Step 5. Research car options. Decide on a new or used vehicle based on your needs and budget. Step 6. Budget and down payment. Determine your monthly budget and start saving for a down payment. Step 7. Explore financing options. Visit dealerships or credit unions to find suitable loan terms. Step 8. Apply for a car loan. Gather required documents and apply for a car loan. Step 9. Choose a vehicle. Once approved, select a vehicle that matches your criteria. Step 10. Register the vehicle. Complete the registration process at a provincial service office to legally own and operate your new car on Canadian roads. Remember, each bank or lender may have different requirements, so discuss your specific situation with them. Now before you hit the road, here's a quick bonus Q&A to address some of your common questions about financing a car. What if you need to cancel your car financing? Give the car back to the lender through voluntary repossession if you can't afford payments. But beware, it may hurt your credit. Consider selling the car to use the money to pay off the loan. Explore refinancing if your current loan terms are challenging. Discuss your situation with the lender. They may offer assistance. Do oil changes and regular maintenance costs come with car financing? No, when you finance a car, oil changes and regular maintenance costs are not included. You must budget for these ongoing expenses separately to keep your car running smoothly and avoid future issues. Keep your car in good condition by scheduling regular checkups for safety. What is the mileage limit for financed cars in Canada? The mileage limit varies based on the lender and loan terms. Unlike other countries, there's no fixed nationwide standard. Discuss with your lender to understand any mileage restrictions before finalizing financing. What types of damage are acceptable on a financed car? Minor wear like scratches or dings is generally acceptable. Significant damage affecting safety, functionality, or resale value may not be allowed. Review your financing agreement and consult your lender for specific damage guidelines. Now, how you can write off your car if you're driving for Uber in Canada. Here's a simple 8-step guide. Remember, all the money you make with Uber is taxable. It's smart to save around 25% of what you earn for taxes. Right from the start, you'll need to have a GST/HST number. You'll have to fill out and send in a form called T2125 along with your tax return. You can deduct the costs of running your vehicle for business purposes like gas and maintenance. You can also claim other expenses like parking fees and cleaning supplies. To report your income and expenses, you'll need things like your annual Uber tax summary, receipts for your expenses, and your total mileage for the year. Make sure you keep detailed records of all your expenses connected to your Uber driving or Uber Eats business expenses so you can claim them on your taxes. If you're not sure about anything, it's always a good idea to talk to a tax pro. They can help you navigate the tax stuff with ease. While I'm not a financial expert and CarSimply doesn't offer financial advice, I'm confident that following the steps outlined in this video will set you on the right path to launch your Uber business. Click on the video on your screen right now to check out the first part of this video focused on leasing, where we discuss the hidden risks of full-time Uber driving. Don't hesitate to leave a comment if you have a question or if you found the information helpful. Your feedback is valuable to us. Join the club and visit our blog at carsimplyclub.com for more insightful content and updates on each video we make. A link will be in the description. Also, don't forget to explore our community section for fun quizzes to test your knowledge from our videos. Thank you for watching all the way to the end. We appreciate your support. This was CarSimply.